Okay, dear SBR students, let us quickly discuss SBR pre-scene mock question number 2. Normally in SBR, the question number 2, I would say one part of that question normally examiner is asking on ethics. But in another part, there will be some IAS or IFRS as well. So, but normally you will have, I would say, number of clues in the question regarding where XYZ company or their seniors, they are going unethical. First of all, there will be some accounting issues. And then, of course, relating to that, they might be doing creative accounting, something like that, obviously to get the benefits, and where, of course, ethics, they will come into play. So we'll see all that area. Let's quickly discuss question number 2, pre-scene mock SBR, and we have already done the question number 1 in our regular online classes. This is question number 2 for all of you. Using exhibit 1, explain with the supporting calculation. Just a minute. Explain with supporting calculation how the sale and leaseback arrangement should be accounted for in GLIM's financial statements. You have to just focus on exhibit 1, and they're saying use explain with calculations. It means only explanation will not work here. With that explanation, you have to give us some numerical areas also. Okay. Let's start from here. I hope it is readable. One of the glimpse invest, and I'll make sure one more thing, that the video should not be very long. Obviously, whoever is watching this, it means exams are very near. So I'll keep that in my mind as well. One of the glimpse investment properties is West Side, which it leases to tenant. Of course, IS 40 investment property. GLIM built this property 2 years ago following the sustainable building guidelines recommended by the government. Subsequently, GLIMS has not followed these guidelines in its new construction project due to cost of applying them. If you don't have funds, it does not mean you are not supposed to follow the guidelines. So here, of course, ethical issue is arising. I think if you're not following the guidelines, it could lead to more than ethics, I would say, problems for you. GLIM applies the fair value model to investment properties, okay, in its interim statement of financial positions. IS 34 deals with interim financial statements. As at 30th June X7, the carrying amount of West Side Tower was equivalent to fair value. The carrying amount and the fair value both were 20 million. The fair value was unchanged December X7. Okay, on December X7, GLIM entered into a sale and leaseback arrangement. December X7, the company is, GLIM is a company, okay? They entered into a sale and leaseback arrangement. In relation to West Sides, in order to realize cash to fund new construction project, they entered into a sale and leaseback arrangement in order to raise the finance so they can construct the new project. The transfer of West Side met the criteria of IFRS 15 revenue from contracts with customers to be a sale. So you can start your answer from this, that criteria of the sale is met. If obviously the criteria of sale is met, then we have to de-recognize our investment property. Under the terms of the sale and leaseback arrangement, West Side was sold for 22 million. Now stop. The carrying amount is 20. That is not the main issue. The main issue is the fair value is also 20 million. And you have managed to sold it for 22. Something, I would say, amazing. That your company is very good. The fair value is 20 million. Why would someone is going to pay you 22 million? So listen carefully. Fair value is 20 and you have received 22 million. So the amount which your GLIM has received over and above the fair value, which is 2 million, that is a loan, financial liability. If you are getting the amount which is over and above the fair value, that is simply a financial liability, 2 million loan, which you have to repay. Immediately lease back, and the time period of lease is 10 years. Payments are made in advance, commence on 31st December X7. Now stop. How to start the answer? Straightforward, you can start the answer like this, that under IFRS 15, the sale criteria is met. So therefore, investment property should be de-recognized, number one. And the second, the fair amount which GLIM has received, which is over and above the fair value, that amount is treated as a loan. The double entry is going to be straightforward. Cash or bank debit by 22 million, investment property credit by 20, and the loan financial liability credit by 2 million. I have written this. This is a sale and leaseback. This is sale and leaseback, and sale criteria under IFRS 15 is met. Therefore, this is the double entry. Cash proceed debit by 22, investment property credit by 20, and loan financial liability credit by 2. Okay, to save the time, I've written the material here also. Answer. Lease payment is 1.25 million per year, and you have to mention the examiner. The amount which is over and above the fair value is treated as a loan. Lease payment are 1.25 million per year if stated carbon emission targets are met in previous 12 months. If the targets are not met, in addition, 0.15 million must be paid in each year, making total annual payment to 1.4 million. Now stop. Logically, the minimum payment which your company will have to pay is 1.25 million, and 0.15 is a variable payment. So right now we should be recognizing our at least the lease payment will have to be on the basis of 1.25 million rental, which are fixed, and 0.15 is variable. Of course, once the criteria is not met, target is not met, then I will recognize that 0.15 million payment I can recognize directly as an expense. But initially, I'm not going to take that 0.15 in my lease liability, because that is variable. When something goes wrong, then I'm going to pay. I'm not paying right now. If the targets are not met, an additional 0.15 million must be paid each year, making total annual payment to 1.4. And these targets were not met on December 7. The following information is available. Present value of future lease payment on the basis of 1.25 is 9.3 million, but they are saying present value minimum lease payment is 9.3 million, but after the first payment. Means from this 9.3, they have deducted 1.25. From this 9.3 million, they have deducted 1.25. It means initially the liability was 9.3 plus 1.25. Initially, the liability was 9.3 plus 1.25, which makes this 10.55, if I'm not wrong. So initially, the lease liability was 10.55. So another point which we need to explain, that lease obligation will have to be equal to the minimum payment, which is a fixed payment of 1.25 every year. Present value of that is 9.3, but this 9.3 is after the deduction of first payment, which means initially the liability is 10.55. Now, by using 10.55, we'll be calculating the value of a right of use asset. How do we calculate the value of a right of use asset? If you recall the formula, right of use asset is equal to carrying amount is equal to lease liability, which is 10.55, divided by carrying amount, which is 20, into fair value 20. Or you can do this also. Right of use asset is equal to lease obligation divided by fair value of the asset multiplied by the carrying amount. There's no issue at all. Here in this question, the carrying amount and the fair value is same. So the right of use asset will be equal to 10.55. Logically, there will be no gain, no loss. Normally, whenever we deal with sale and lease back, we do get gain or loss on transfer. But here we are not getting any gain, we are not getting any loss. So logically, your right of use asset and the lease obligation both are 10.55. Day one, right of use asset debited by 10.55, lease liability credited by 10.55. But immediately, you will be preparing one more entry, which is lease obligation debited by 1.25, and the cash or bank will be credited by 1.25, because we make the payment in advance. In first payment, of course, there will be no finance cost because we are making payments in advance. And one more thing we'll have to explain our examiner here, the right of use asset is an investment property, which means that this right of use asset will have to be revalued to the fair value, and whatever the change comes in the fair value, that you will have to take to the P&L. Repeat. Here, A right of use asset is an investment property, which means that this right of use asset will have to be revalued to the fair value. And whatever the change comes in the fair value, that will be taken to the P&L. So students, I have written this all here. So right of use asset debit by 10.55, lease obligation credit by 10.55, no profit and loss because carrying amount they are equal to fair value. Then I have given the reference of IS 40. Then it is mentioned in the question that criteria was not met, so we end up by paying 1.4. So simply the additional 0.15 payment is treated as an expense. The double entry is here. Lease obligation debited by 1.25. Expense 0.15. I'm not going to recognize 1.4 million annual payment initially because that within that 1.25 is fixed, 0.15 is variable. I'm not recognizing that variable part in day one. So that is where what is happening. Our lease obligation is on the basis of minimum payment, but of course target is not met. We had to pay more than that. So whatever we are paying more than 1.25, it is an expense. Double entry, you can see that here. So that is all about part A. First, you need to explain it is a sale. So you have to de-recognize your investment property. Another point is sale and lease back. Plus, you have to mention that consideration which GLIM is receiving, it is more than the fair value. Additional amount which is over and above the fair value, it is loan, financial liability, because you have to repay that as well. Next point is initially the liability will be equal to on the basis of fixed payments, which is 1.25 is the minimum fixed payment. 0.15 which is additional, that is a variable payment. So initially I'm not going to recognize my lease liability including that variable element also. Initially it will be on the basis of fixed amount, and then later on, of course, when I have to pay more than 1.25, I will treat that as an expense, which we have done it. Plus one more point, you were supposed to write that right of use asset here is an investment property, so that asset should be revalued and the change in the fair value will go to P&L. Now let's go to the next part B. Using Exhibit 1 to discuss ethical issues arising from Bimal's instruction to Shami and explain how Shami should proceed. How Shami should proceed. Let's see. Bimal, the finance director of GLIM company, is an ACCA qualified. It means you should know everything about ethics, accounts, everything. Bimal is a finance director, okay? ACCA qualified. He has just returned to work after an extended period of leave. Now stop. If someone is returning to the work after an extended period of leave, there's a clue for you, there's a hint for you that that person's knowledge about ISS and IFRS will not be up to date. And of course, we are human beings, we tend to forget. So due to that extended leaves, how extended, that's a separate question, but at least one thing should come in mind, that it looks that Bimal might not be so much updated with ISS and IFRS, especially if there has been any new IS or IFRS, there has been any change. So it looks Bimal might not be having the knowledge of that area. He has sent the following email to Shami, the finance manager. Here we are, Shami, finance manager. Shami, in respect of sale and leaseback arrangement, I think we should assume that missing the emission target 2007 was unusual, and since West Side was constructed in accordance with the sustainable buildings guidelines, the target is highly likely to met in all other years. Stop. He's saying let's assume the target which we met, it was unusual, and not to worry. He believes that in the future we are going to meet all the targets. Now listen and listen carefully. Bimal, we have actually missed the target. we actually did not meet the target. And on what basis you are saying that in the future we will be meeting the targets? Right now you have not met the target. How can you hide this information? And why you want to hide it? I believe that meeting this highly likely threshold means that you should recognize a sale and lease back liability based on the future lease payment 1.25 million rather than 1.4. This will keep the glimpse finance cost to the minimum possible, help to ensure that debt service covenant put in place by the bank are met. Now listen to me carefully. It is quite obvious after reading this. BIML. Why BIML is going for, I would say, creative accounting? Actually, BIML wants to show the minimum finance cost so that there shouldn't be any breach of covenant. So that whatever loan they have already taken from the bank, that should be there intact. It should look that GLIM company is very good. They are not going towards any breach of contract. There will be no breach of covenant. It means all this is done to save that covenant. Okay. Also, when you draft GLIM's sustainability disclosure, IFRS S1, there won't be much to write about at all. I think that most of the content should focus on the fact that GLIM applies sustainable building practices and as a result can access cheaper finance. Wow, wow, wow. Shami is also an ACCA qualified accountant. It means he should be having a really good knowledge of all the ISS, IFRSs along with ethics, of course, and keeps up to date. Wow. With reporting regulation and requirements, she's concerned about the instruction given by the BIML but unsure what to do about it. Now listen. Number one, when you are answering a question on ethics, so how to approach? First of all, if you look at the scenario, it is quite obvious from the scenario that BIML is going towards, deliberately wants to go towards creative accounting. BIML deliberately wants to hide the information. What is motivating BIML to do that? So that there shouldn't be any breach of covenant. That is why BIML is saying everything is fine. So basically, Shami, how Shami should proceed now? First of all, Shami should raise all her concerns to BIML. Of course, in a very polite manner, in a within a professional, you have to maintain your professionalism as well. But you need to communicate to BIML about his, you can say that lack of, you can say right now, he's not, apparently it looks that BIML is not updated with ISS and IFRSs. So you should basically explain BIML then what is the exact accounting treatment. We should be following that rather than just showing everything is fine, even though which is not. Plus, you should be explaining the term greenwashing to BIML, that when your practices are not environmental friendly, when your practices are not what you should be supposed to follow, and deliberately you are providing the information that our practices, everything is fine regarding environment, that is greenwashing, which you should be explaining to BIML the term greenwashing. Let's say Shami has raised all her concern in a very polite manner, in a keeping that professionalism. Let's say Shami has explained each and everything to BIML, but BIML is still not ready to listen to Shami. Then what should be done? Then of course Shami should raise this concern with other board members, audit committee. Even Shami can take help from ACCA. Even Shami can take a legal advice. And Shami should, of course, inform board about the lack of, I would say, updated knowledge which BIML is having right now. It looks that BIML does not have any knowledge about IFRS S1 sustainability journal disclosure, that which we have to provide. We should be providing it. That what sort of a risk relating to our business, what sort of risk and opportunities our business is facing relating to our business, relating to the industry. So it looks that BIML is not updated with IFRS S1. So simply, if I summarize everything, of course, BIML looks dishonest here. He's not keeping his integrity. Doesn't look honest at all. But how to answer? Look at this. I have written here for you. BIML state, I think we should assume that missing, this is I've just taken from the question. BIML does not want to have a breach of covenant. I mentioned this. You have to just read. The last thing is Shami should communicate with BIML and express her concern about BIML's apparent lack of integrity with him and explain the concept of greenwashing to him. Shami should retain all the record of all conversation with BIML. If this does not work, then Shami may approach other board members, audit committee, or may contact ACCA or even take a legal help, legal advice. So students, that was all about, I would say, SBR question 2 pre-scene mock. Of course, if you will be reading the examiner's answer, let me tell you one thing, students. Regarding IFRS S1, I have mentioned here, the sustainability standard requires disclosure that provide a complete, neutral, accurate description of sustainability-related risk and opportunities. They should, for GLIM, reflect the risk associated with its normal business practices, industry within which it operates. These 2 to 3 lines regarding IFRS S1, they are more than enough. But of course, if you will be reading the suggested answer of pre-C mock, the volume which they produce, nobody is expecting from you to produce the same volume. Not possible. Nobody is expecting, because you will be writing your answer in an examination environment, in a time-bound condition, which of course suggested answer is not written in a time-bound condition. Suggested answer is there to help you, to teach you, in fact, to give you more knowledge. But nobody is expecting the same volume and the same quality which is in the ACCA pre-scene mock. We are not expecting the same quality from students. So as far as your account, whatever you are writing, it is according to the IFRSs, and you are highlighting the ethical issues within that context, which is in the question, you will get really good marks. So that is all about SBR pre-scene mock question number 2. Question 1, students, we have already done in our regular online classes. And let me tell you one thing about ASA, Abil School of Accountancy. All of our ACCA, if I talk about SBR, all of our pre-recorded lectures are just on average 40 to 45 minutes long. One lecture is on average 45 minutes long, not more than that. Second, we conduct weekly live revision classes. Third, we provide the best and fastest WhatsApp support to the ACCA students, not in SBR paper, in all ACCA papers. Plus in SBR, we provide detailed and short notes to our students. And one more thing, entire SBR revision, within, I would say, 12 hours, the entire SBR could be revised. And the revision of, you can say, a crash course where within 12 hours, the entire SBR revision is there. It is included in our regular classes. So you will be getting pre-recorded classes for the entire SBR. Within that, there's a 12 hours crash course, which is also included. So within 12 hours, you can just revise the entire SBR. Just by spending 12 hours, you can revise the entire SBR. Plus, we conduct weekly live revision classes. And to be very honest, short notes is we are not only providing the detailed notes, we are providing the short notes to our students. By using those short notes, our student can revise the entire SBR just within 3 to 2 hours. So what else do you need and what are you waiting for? And we provide the same level of services in all ACCA papers. Thank you very much for watching this lecture. Hope to see you all in different papers, not in SBR. I hope you people are going to pass SBR this time, inshallah. And I'm expecting you in other papers. Thank you very much.